Inverse head and shoulders chart pattern. In this video you will learn what the inverse head and shoulders pattern is, how to identify the pattern, how to trade the pattern. The inverse head and shoulders, as the name implies, is the opposite of the head and shoulders top pattern. It is the trend reversal pattern found at the end of a downtrend. In this video, we will look at what the pattern looks like and how you can trade it. As with the head and shoulders top pattern, the inverse head and shoulders is identified by its left shoulder, head, right shoulder and neckline. Due to the pattern being a reversal pattern, you want to look for it after a big down move. Once you have identified a completed pattern with a formed right shoulder and price breaks above the neckline, you can look to go long. It is a good idea to wait for a candle close above the neckline before you look to enter a long position, as it confirms that the bulls are in control and avoids false breaks. You can place a stop loss below the right shoulder in case the pattern fails and price continues moving down. To calculate the profit target, measure the distance between the head and the neckline of the pattern, and then extend this distance from the neckline in the direction of the breakout. Another way to trade the inverse head and shoulders pattern is to wait for price to break and close above the neckline, as in the first example. This is noted as broken resistance. However, instead of entering after the close of the candle, look for price to retest the neckline before buying, as this level is now seen as support by many traders. This will give you a better entry level and will allow for a smaller stop loss, as you can place the stop loss below the new support area. The profit target is found using the same method as before, where you would measure the distance between the head and neckline of the pattern and then extend this distance from the neckline in the direction of the breakout. So far, you have learned that the inverse or reverse head and shoulders is a reversal pattern that occurs after a downtrend and indicates possible buying opportunities. You enter when the price breaks through the neckline after the right shoulder has completed and the candle has closed above the neckline. The stop loss would go below the right shoulder and the profit target would go the same distance away from the neckline as the neckline to the head. The second way that you can enter is to wait until the price breaks through the neckline and then comes back down to retest the neckline as support. The stop loss would go below the new support level and the profit target goes the same distance away from the neckline as the neckline to the head.